Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Good afternoon, everybody, and welcome to another episode of Reynolds Wrap. I'm Don Reynolds, and of course, Cory Stilp, my good friend and business partner, joining me.
Hello, everyone.
So today we're going to talk about investment returns because, is it fake or is it fact?
Yeah.
I call it the myth because I think people kind of get a misnomer when they're making 15, 20%. And then they lose 20, they think they're still up. So we're going to talk about a couple scenarios to give you something to think about today. And, what we say is average great? Well, I don't know. I guess we'll leave that to be determined by you after we talk about this. But I think average is very misgiving, if you will, and misleading even is probably a better word. So what we're talking about, we'll give you one example here. Let's say you started with $100,000 balance in an account. And then that year, maybe it was Bitcoin, who knows, but you hit it and you made 60% return. So now you're up to $160,000. That's great. But then, of course, year two comes and things go, completely opposite. And now you lose 50%. And we know that's happened in the past. It's been quite a few years, but we know it can happen, I guess. The key is to get the point across here. And so now your balance is down to 80,000. And then year three, you make the 20% return, which certainly we know those are reasonable and realistic. They happen. So after 3 years, you've got $96,000. So you're still $4,000 short. But if you do the math, that's a 10% per year average return. So again, is average great? We don't necessarily think so.
Yeah. It's a play on words, maybe perhaps, that really is concerning to us, especially when you're looking at retirement, folks. And the key there being, again, is a lot of mutual fund companies or different investments. It doesn't have to necessarily be a mutual fund company. Might advertise that they averaged 10% over the last 3 years, or I've averaged 15% over the last 10 years. Again, an average return, you've got to really dig into it and look at it and say, boy, how did we get to that average? Because it's not so much the average, it's what happened year by year that is very, very concerning as you near retirement. Because most people would think, if I were to say to you, and Don will lead you through this example in a minute, would you rather have a guaranteed average of 11% over 3 years on a return for an investment? Or would you rather have an investment that has a cap? In other words, we're going to limit how much you can make on the upside of 9%. But we're also going to give you a floor or a guarantee that you cannot lose a penny. There's a zero on the bottom of that return. What would you rather have? Now, I can hear the listeners thinking, what we would probably want, but let Don lead you through this example to understand again what average means.
Well, yeah, and always those big numbers, they sound so great. They kind of, they hook us, if you will. And that's the misnomer that's happening out here with people. And like Cory said, especially in retirement, this is where this can really, really affect people long term. So what Cory was saying is, let's say you had $1 million. And again, it doesn't matter what the number is, folks. It's the concept behind this that we really want to drive this home. So you start out with $1 million. In the first year, you made 50%. So now you're at $1.5 million. Year two, it drops 50%. Now you're at 750,000. And then year three, it goes up 33%. So you're back up to your $1 million. Now, if you do that math with the averages, you averaged 11% per year return, but yet your money hasn't grown at all over a 3-year period. Whereas we take that same 9% cap with the zero floor. So in the first year, when the market went up 50, you only got 9. So you're at $1,090,000. Then year two, market drops 50. Of course, we have a floor of 0. So our balance stays the same. It's still $1,080,000, or excuse me, $1,090,000. And then year three, the market goes up 33%. Well, we're only going to get our 9 again. So that puts us up to 1,188,100, or our average is 5.9% average for the 3 years. So that's where we want people to understand. Would you rather have 11% average and you basically earn nothing? Or would you rather have 5.9 and earn $188,000?
Yeah. Yeah. And that's, again, I know it's a head scratcher because, again, numbers just seem like it doesn't work out that way. But the key is, again, having that floor of zero. And I know a lot of our clients have heard us say this, that zero is our hero in those years when the market goes down. And that's really what we're talking about here. Now, no one likes to get a 9% cap if the market went up 33% or went up 50%. And again, that's where I feel all too often a lot of people in our industry will play on people's greed and say, well, you don't want to lose all of that upside potential. But then again, when you really look at the scenario here and you really look at the hard factual data, again, preventing those losses and giving yourself a guaranteed floor of zero in those down years can make a drastic difference. Now, again, we're not talking about this for all the money for our listeners. Again, you've got to come in for that no cost, no obligation meeting. We've got a process we'll lead you through. We're going to look at your entire scenario. We're going to look at your income needs, your budget, the taxation piece, and we're going to look at maybe a portion of it needs to make sure that we get it away from this average return scenario and have that floor of zero perhaps to help provide that income. Because again, you don't want to be going through that average of 11%. Where you're up and then you're down and then you're back up. You got your average of 11, but you're taking money off. That's that sequence of return risk that I know we've talked about many times.
Yeah. And when you have a scenario like you just said, and you are drawing off the asset, that's a whole different world.
Yeah.
And it can devastate people. We've seen it many times in my career. I've seen that happen to people.
Yeah.
And unfortunately, generally by the time they realize what's happening, it's too late to fix it. I can go back to 2008 when I met with people after that. And, I had to tell people they had to go back to work because there's nothing I could do to fix the problem because they didn't change their, the mentality, the philosophy. When you retire and you've built your engine, we call it your engine or your machine that's going to pay out dollars for the rest of your life. You have to change the philosophy about how it's invested. It kind of goes back to a previous episode where we talked about the S&P average over a 20-year period versus the U.S. aggregate bond. And if you remember that episode, that was a drastic difference because of the volatility. Even though the returns averaged higher by 1.5% almost, you still had way less money at the end of the 20 years because of the volatility. That's a sequence of return risk that we preach and preach.
Yeah.
So with that, we want to thank you. Cory, you got anything you want to add?
No, just feel free to give us a call. Our office number is always 651-773-3859. Whether you have questions on any episode or this episode, we'd be happy to help you, whether it be over phone or more than, we'd love to have you in, sit down with us in person. We can go through this and show you the black and white data. Again, no cost, no obligation on our process and on our meetings. We start with that discovery meeting. So give us that call, 651-773-3859.
Thanks very much, folks.
Have a great day.
Next time.
Listen to more with Don Reynolds and Cory Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.